Hello and welcome to today's webinar during Ag Smart Money Week, brought to you by the University of Nebraska-Lincoln Center for Agricultural Profitability and Nebraska Extension. I'm Shannon Sand, Extension Educator and Agricultural Economist with the Center for Ag Profitability. Ag Smart Money Week is all about helping Nebraska farmers and ranchers strengthen their financial management and risk management skills. Through webinars held throughout the week, we're sharing timely information and tools to help producers make informed decisions for their operations. You can find the full schedule and registration details on our website at cap.unl.edu/smartmoney. This week, we've been talking in our webinars about specific tools available to help producers manage their business. Today, we're excited to talk big picture as we turn to the latest projections and outlook information related to farm income in Nebraska and the U.S. Nebraska's farm income prospects remain mixed for the year ahead, with lower crop revenues balanced by continued strength in the cattle sector and substantial government assistance. The net result is a projected increase in overall farm income for 2025, even as some producers continue to face financial pressure. Our presenters will help unpack those numbers and provide deeper insight into the factors shaping the outlook for both Nebraska and the nation. We're joined by Dr. Brad Lubben, Extension Associate Professor and Policy Analyst with the University of Nebraska-Lincoln, and Dr. Alejandro Plastina, Associate Professor of Agricultural Finance and the Director of the Rural and Farm Finance Policy Analysis Center at the University of Missouri. We encourage your questions throughout today's presentations. Please feel free to type them into the Q&A or the chat box. With that, Brad, I'll turn it over to you.
Shannon, thank you very much, and appreciate the opportunity to be part of the Smart Money Week here. It is a big picture issue as we talk about farm income prospects here in Nebraska and across the United States. And we're pleased to look at that through the lens of some work with the University of Missouri and the Rural and Farm Finance Policy Analysis Center. I'm pleased to help lead that effort here from the Center for Ag Profitability at the University of Nebraska. But we're pleased to actually work with an alum, a University of Nebraska alum, Alejandro Plastina. Dr. Plastina is the director of the Rural and Farm Finance Policy Analysis Center at the University of Missouri, and certainly a leader in this analysis and outlook of where we are with U.S. farm income and the analysis that we do at the state level here for Nebraska. So we're going to start with that big picture at the United States level, follow that up with a closer look here at Nebraska, before we wrap up with broader discussion and questions and answers. So Alejandro, I'd invite you to share your presentation, and we're happy to turn it over to you.
Okay, thank you very much, Shannon and Brad, for that fantastic introduction. I really appreciate the opportunity to be part of this webinar. Very important topics, the ones that you've already covered this week, and hopefully these will add the big picture, as Brad said. The Rural and Farm Finance Policy Analysis Center collaborates with Brad's team, the University of Nebraska, and several other land-grant universities to develop farm-level farm income projections twice per year, usually in April and October. And we are happy to be able to share some insights with you. But for this presentation, I will focus on the U.S. farm income projections in particular, and most of the analysis will be on USDA data and FABRI data. Let's see if I can advance my slides. Yes, a few words about the RAF. RAF is a Policy Analysis Center at the University of Missouri-Columbia, and this is funded by U.S. Congress. We work with the Office of the Chief Economist at USDA to develop our plan of work. And our goal is to provide unbiased analysis to policymakers to help them understand how policies impact different states and regions differently. And we hope to support agricultural and rural economies throughout the United States with our work. the two of the major topics that we have been covering lately are related to farm financial stress, and we've published the leading indicators of farm financial stress report twice already this year, and we will update that report again by the end of the year. And of course, farm income, our focus for this session, and we publish this farm income outlook for Nebraska, Missouri, and 8 other states. And I guess I mentioned it's published in the spring and the fall, and you can access them through raf.missouri.edu. If you want to interact with the data instead of just reading the report, you can access our Farm Earnings Explorer, and this is a dashboard that allows users to analyze trends, compare states, or compare different commodities across states. So I invite everyone also to check this Farm Earnings Explorer too. Now, my presentation will be about the U.S. farm income, and this is clearly a tale of two sectors, as was anticipated during the introduction. We are in the third year of declining cash receipts for field crops, and the second year of increasing cash receipts for livestock. So two sectors that are doing very differently in terms of revenues and in terms of profitability. Particularly within the livestock sector, cattle seems to be doing very well. There's limited supply, although that is increasing feeder cattle prices, but on the other side, lower commodity prices are lowering feed costs, and overall cattle seems to remain resilient to any challenges that have been rising lately. As Brad mentioned, there are sizable ad hoc direct government payments coming in 2025. Some of them have already been disbursed. Some are expected to be disbursed once the government shutdown ends. And based on the livestock sector and these government payments, the U.S. farm sector would see its net farm income increase in 2025, and but without those ad hoc government payments extending to 2026 at a similar rate to what we have seen in 2025, we expect that net farm income to decline again in 2026. Right now, the policy outlook is very uncertain. As you all know, there are issues about trade and tariffs, big questions that are being revised. As we speak, there are rumors about new ad hoc aid being delivered over the next 2 months, on top of what has already been approved early in the year. And we don't know exactly how economic growth will react to this uncertainty and how demand will react based on that economic growth pattern. So when we look at corn, 2025 has been or is expected to be a record year in terms of production, with record yields, lots of area planted in anticipation of the trade challenges for soybeans. There was a tremendous increase in area planted early on that resulted in a record high production. On the demand side of that production, we've seen increased domestic use and also sustained export levels for 2025, according to USDA projections. But the increase on the demand side is insufficient to absorb all that bumper crop. So ending stocks are projected to increase substantially in 2025. And that's pretty much the same picture painted by FAPRI projections. So FAPRI, the Food and Agricultural Policy Research Institute at the University of Missouri. And both USDA and FAPRI are projecting much lower marketing average prices for corn in 2025-26 than in the previous crop year. So 390 USDA and 405 per bushel by FAPRI. Now going into 2026 crop, USDA hasn't published yet projections for the next crop year, but FAPRI has updated those projections recently, and we see that production is expected to decline since both yields should be more normal and a little bit of lower planted area would contribute to lower production. Feed use would be slightly lower. Exports are expected to be robust, but still that ending stock will be higher in 2026, marketing year 26-27 than in 24-25. So an improvement over what we expect for this crop year in 25-26. So prices are projected to go up from 405 to 420 for corn, between 25 and 26. It is an improvement, but we're still way below prices seen in 2022 and 2023, right? So that's a challenge. For wheat, wheat is more stable in both in the sense of production is stable and demand is stable. So prices are a little bit lower in 2025 according to USDA because of the international dynamics. But for FAPRI, the decline in price is not that big as that projected by USDA. Going into next year, prices are expected to go up somewhat because FAPRI is projecting lower production and stable demand. Even an increase in ending stocks would not affect wheat prices substantially. So, stable to improving conditions in the wheat market. When we look at longer term projections of prices, USDA, FAPRI, and even the futures prices are, paint a similar picture. We are at a point where prices could start going up again in future crop years, but clearly not to the record highs that we've seen in 22 or even somewhat lower 2023, 2024. So prices for corn and wheat not expected to be to pick up fast enough to face increases in costs. So that's for corn and soybeans, for corn and wheat. For soybeans, of course, since so much of this crop is exported, and there were several challenges to exports, particularly the import demand from China. We've seen a decline in exports, although now the new trade deal with China apparently would normalize that imports from China of US soybean. Both USDA and FAPRI are projecting overall lower exports than last year and lower production, of course, since so much area went to other crops, went out of soybeans in 2025, and production declined, but not proportionally to area, because yields were very high in 2025 across the nation. So we are seeing a situation of stable prices in 2025 with respect to last year, and looking into next year, well, more area is expected to be planted to soybeans. Production is expected to be higher, as well as demand side will be the demand for soybeans should be higher too, with higher exports and higher domestic crushing. So ending stocks would decline, and that would sustain higher prices. Again, an improvement in prices that does not bring the soybean price to 2023, 24 levels, right? So those are sustained challenges on the soybean industry. And even when we look at the meal and oil, if biofuel policies keep expanding the demand for oil, then soybean oil might increase in prices, but not as much as, not to the level seen in 2022. And meal is not expected to pick up much according to FAPRI projections. So when we expand the look to other crops, both cotton, sugar, other oil seeds, total feed grains, they are not expected to improve substantially. Yes, there is some room for improvements, particularly for oil seeds, but not to a point seen in 2022 or 2023, unfortunately. Now, other crops, what you see in this chart as the top crop, those are specialty crops, usually vegetables, nuts, tree nuts. So those prices are expected to continue growing, but for row crops, mostly those projections are not very favorable in terms of higher prices. On the other side, crop production costs have declined from their peaks somewhat, but they're again going up. Particularly fertilizer hasn't declined as much as crop prices have. So the relationship between fast declining crop prices and slowly declining costs is putting a crunch in the profitability margins of crop producers, right? So even after the slight decline in costs seen recently, in some line items, costs still remain above 2021, 2022 costs, right? So that, as I mentioned, is not very positive for the outlook for crops. Now, the other sector, I said this is a tale of two sectors. The other sector has been doing much better as of lately in terms of cash receipts. And we've seen increases in poultry and eggs cash receipts, in dairy, in hogs, and of course in cattle from last year to 2025. So strong demand, high prices in eggs and poultry. The highly pathogenic avian influenza has been playing a major role, and those owners of flocks that could still produce eggs and meat, poultry meat, their profits actually went up with the increase in prices. So livestock in general has been doing much better in 2025 than in previous years. But while some sectors within the animal and animal production system can expect to continue seeing higher cash receipts into 2026, not all of them. So if we anticipate that avian influenza will be less, will have a lesser effect, a smaller effect on the production of poultry and eggs, then prices should remain to more normal levels, lower levels, and that will affect, of course, the cash receipts. Those should go down with the prices. On the other hand, hogs are expected to remain at similar prices going into 2026. Dairy products also pretty much stable. And cattle is one livestock sector where prices are expected to continue growing because the cycle is close to leveling off, and the beef cow herd would start to rebuild in 2026, according to Fabri's projections. So still very tight inventories supporting higher prices. And it's not just this year, but probably the next couple of years that we will see high steer prices. And of course, while that's great on the cash receipts side for livestock, for cattle producers, the price of feeder cattle, purchased livestock, continues increasing, and that's an input for many producers. So the costs are expected to continue growing. So margins probably will stabilize and then will start to decline because feed costs have been declining given the decline in crop prices. But going into the next couple of years, those prices should start to slowly grow again. And with higher cost of for feeder cattle, then profit margins in the cattle sector will be smaller going forward than what they have been so far in the last couple of years. So those two sectors are very different. And the third component of our farm income projection is related to the government payments, right? We've heard, we've seen several programs take place, mostly as supplemental and ad hoc disaster assistance from the American Relief Act of 2025, signed in December 2024. And the USDA is projecting $35.2 billion in these disaster assistance payments, which is higher than the similar concept during the COVID year in 2020. At that time, that was 31.4 million. The only reason why in 2025 the government payments are smaller than during 2020 is because in 2020 we saw the market facilitation program, right? But there are rumors that there might be some kind of MFP program for 2025 once Congress reopens the government, once the government shutdown ends. Sorry. So the other programs, ARC and PLC, are not really contributing much to net farm income in 2025, and these are one-off types of programs. So they have been approved, but they haven't been fully disbursed as of October 10, 2025, which is the last time that the Farm Service Agency has updated their website. So far in this year, about 52% of these disaster assistance payments have been disbursed, around $16 billion, and there remains to be the balance is almost $15 billion, which we anticipate that will not be paid out in 2025. A big chunk of those payments will probably end up being disbursed in 2026. Well, taking into account these three major factors, crop sector with lower cash receipts, the livestock sector with higher cash receipts and government payments contributing substantially to net farm income. USDA projects an increase in net farm income of 41% That's equivalent to $52 billion with respect to last year. So that's a substantial increase. Again, if we take into account how much government payments contribute to that, that is a substantial amount. And when we look at FAPRI's projection, well, FAPRI also projects a substantial increase in 2025, around $50 billion compared to 2024. That would be around 34%. But going forward, that's a piece of information that USDA does not provide at this point. Going forward, FAPRI projects a decline in net farm income, a substantial decline of around $31 billion. And that has to do with the path of government payments. Farm receipts are expected to go up by $22.8 billion in 2025. Total expenses to go up by about $14.3 billion in 25. Government payments, $30 billion. So the net farm income in 25 is expected to go up by almost $49 billion, according to FAPRI. In 2026, farm receipts, both crops and livestock, would slightly go down. Total expenses would increase by more than the decline in farm receipts. So that's a substantial accumulated reduction in profits. Government payments would go down by $21.6 billion compared to the 2025 levels, because there's no reason to assume that current disaster assistance payments will be renewed going forward. As a result, net farm income would decline by $31 billion. Now, that's the picture for the nation based on FAPRI and USDA. I just want to introduce a very brief summary of what we did across the 10 states covered by RAF. We did similar analysis using farm state level data. And you can see in these two graphs, the first one is about net farm income in 2025 and the second in 2026. And these are changes in different components of net farm income. And it's easy to see based on the dark bars and the golden bars that changes in government payments and changes in livestock receipts are the main drivers of changes in net farm income in 2025 across the 10 states. And if our projections are realized, then the changes in government payments will be substantial drivers. The decline in government payments will also result in a decline in net farm income in 2026. So besides what I just discussed, there are, again, significant sources of uncertainties regarding trade deals and tariffs and interest rates, how low those can go, what will happen with manufactured input costs. Will there be new supplemental and ad hoc assistance payments or not? How the biofuels policy be implemented and RINs and so on, and then how economic growth might affect demand for livestock and for farm products. So at this point, I will stop and invite any technical questions. If not, at the end, we can have a more thorough discussion after Brad's presentation. Again, thank you very much for your attention, and thanks for the invitation to participate in this webinar.
Alejandro, thank you very much for that discussion. That helps set the stage for the broader outlook here. Shannon, any questions that we want to deal with at the moment?
No, not at this moment.
Okay. Well, if you'll indulge me, then I'll go ahead and share and get started on the Nebraska version here. All right. How does that look to everybody?
Looks good.
Okay, we're good to go then. So again, thank you for the opportunity to collaborate on this farm income outlook for Nebraska. And thank you to those that are participating today to to get a picture here of where we are with Nebraska farm income. Alejandro described it correctly as a tale of two sectors. It's a bit the same story that we told back in the spring. And when we look at farm income in Nebraska, the key issues are about the crop and the livestock sector. Almost it's sort of realizing entirely different worlds out there, or at least entirely different perspectives. We described it in the spring. I mentioned it's like a tale of two farms, or more specifically, a tale of a farm and a ranch, because the economic prospects on the crop side certainly look very different than the economic prospects on the livestock side. Of course, it's also about production costs. It's also about government payments and the broader farm income safety net. But ultimately, it's going to be management decisions that deal with the current situation and look us through to the coming years. So if we try and talk about farm income numbers in general, and you get the perspective that, yes, the headline said Nebraska net farm income up, 46%, I believe the number was. It's near record. Actually, in the spring, we were projecting almost record net farm income for Nebraska in 2025. So technically, it's down a little bit from that projection, but it's hard to sort of characterize near record or very strong net farm income numbers in Nebraska at the same time that we're seeing headlines and concerns about economic conditions and financial concerns in agriculture. And this headline went out yesterday across Nebraska, and I know that we've seen responses, and I've seen email that said, that's not what's happening on my farm, or come and see our sector, it doesn't look that way. Well, there's a couple stories behind that. Yes, the aggregate numbers do show us that we see near record net farm income in Nebraska. But you already see on this chart, when you try and disaggregate net farm income from the market plus government payments, the government payments are a huge part of the move up in farm income this year. And Alejandro already talked about some scope of those payments and some questions about what's ahead. But projected government payments are a very big part of the bottom line here for Nebraska farm income in 2025. In real terms, even though, as we noted, it's up, this would be the second or third highest net farm income number on record. It's still down in real terms from what those record levels were, but it's still above a long run average here. So even in real terms, the aggregate number looks fairly strong. But again, it's this tale of two sectors. In particular, in Nebraska, it's as simple as comparing crops to livestock. The crop receipts in Nebraska are about 90% corn and soybeans, according to some recent averages. And those numbers are down from 16 billion plus to around 12 billion. That's a substantial drop, about a 30% drop in corn receipts and about a similar 30% drop in soybean receipts. And so crop prospects are down sharply in Nebraska. At the same time, livestock receipts are up, and that's about 90% cattle and calves. So livestock receipts have actually been growing since 2020, but even since 2022, they're up from about 16 billion to about 23 billion plus. In 2022, crops and livestock were roughly equal in Nebraska. In 2025, the outlook suggests that livestock receipts will more than double crop receipts in the state. That's the shift in fortunes that we've seen over the last 4 years. Now, the other line that shows up on there is government payments, and government payments have increased dramatically in Nebraska, similar to what Alejandro discussed nationally. We're up $2 billion in government payments this year, and that's a huge part of that bottom line that I showed just a bit ago. So it is clearly a question and a story about receipts and about two sectors seemingly moving in different directions. It's also the reality that particularly crop prospects are going down at the same time that farm expenses are still up, and particularly up on and near record highs. And in fact, as an aggregate, net farm income or Nebraska farm expenses on aggregate are projected to hit a record in 2025, over $30 billion of expenses. So you calculate total receipts, and as soon as you subtract expenses, you get a pretty quick realization that tight margins are the rule of the day. Now, of note here, the biggest category of expenses is intermediate product expenses. That category fundamentally includes all of the purchased inputs that would expect, other than labor and interest and a few minor categories and other overhead. That includes seed and fertilizer and chemical. That also includes fuel and energy and other purchased inputs. It also includes purchased feed and purchased livestock. And if I back out feed and livestock, those are the farm origin expenses. Those have gone up rather dramatically in the last 5 years. Well, a very large part of that is purchased livestock, purchased calves. And as cattle prices have gone up, so have feeder calf prices, and thus the value of purchased livestock has gone up dramatically as well. So total livestock receipts, we said, are approaching 24 billion. Well, purchased inputs, including feed and livestock, are approaching 16 to 17 billion. So recognize that even in a record receipts sector like the cattle sector, it's still a margin business, and the margins are tight there as they are in other places, and the concerns about the outlook ahead. Now, if you look at the other lines, they sort of pale in comparison to where we are with farm origin inputs. But manufactured inputs and other overhead are also up sharply from where they were roughly 15 years ago. They're relatively stable in the last year or two, but they're up sharply from where we've been in recent history. So there is that feeling of increased expenses. Even if they're not continuing to increase at that rate, they're at near record levels, and they have been a very heavy anchor on farm income prospects in the state. Now, of course, there's the one other part of the ledger. It isn't just market receipts minus production expenses, because government payments have added to that safety net as well. And just as we saw nationally, this is the picture in Nebraska. We have expected government payments in Nebraska for 2025 of around $2.2 billion. That is second only to the pandemic year of 2020. And that pandemic year included a little bit of carryover market facilitation program payments from 2019, but fundamentally included substantial economic and disaster assistance payments amid the COVID-19 pandemic. Well, we wouldn't have expected to maintain those levels of government spending, and yet here in 2025, that's exactly what we're projecting. A combination of some of the standing disaster assistance programs like LFP and LIP, but mostly a rollout of $31 billion in ad hoc assistance that was passed by Congress in December of 24. $10 billion in economic assistance, $21 billion in ag disaster assistance. As Alejandro noted, not all of that has been rolled out to date. In fact, the ag disaster assistance portion is less than half paid out to date. With the ongoing sign-up procedures, and now with the government shutdown of more than a month, there are expectations that it won't all get paid out in 2025. And that's exactly what the assumptions that went into the projections that were made. So some of that assistance is still expected before the end of the year, provided the government does reopen at some point, and that FSA offices are able to distribute the payments. Some of that assistance is assumed to roll over into 2026 regardless. So the numbers are big, and the contribution of government payments to the bottom line is a substantial part of that. There have been ARC and PLC payments made to Nebraska producers in the last week or so. There are some payments relative to the 24 crop that are paid in 25, but they pale in comparison to the ad hoc payments we've seen. And there is expectations that we'll see substantially bigger ARC and PLC payments in 26 that are based on the 25 crop, but that's the projection for the year ahead. If we plug those numbers all together here for 2025, that's where we move from about a 5.9 billion net farm income in 24 to an 8.4 billion projection here for 2025. It really is crops down, livestock up, production expenses dramatically higher, which is a negative on this waterfall chart, government payments are dramatically higher, and that leads you to the increase in net farm income. Now we can look ahead, and we have an aggregate number that we've published in the Nebraska report. We have online data, the tables that are used to publish these reports that are also available on the website, and those will show the projections for the coming years as well. Recognize that the projections for the next decade fundamentally assume current conditions plus ultimately a return to long-run trends. And that's either long-run averages or trending patterns in the long-run factors here. But if you plug those in for the next year, there are continued assumptions that livestock receipts will be higher as we continue to sort of challenge tight cattle supplies versus consumer demand. So we might see even higher record prices in livestock, barring some of the livestock price losses we've seen in the last couple of weeks. We might see a little bit of recovery in crop receipts as prices maybe look to be more stabilized and move higher. But ultimately, you add those pluses with the expectation that government payments fall back sharply, and we end up roughly flat for the year ahead from 25 into 26, maybe a relatively flat projection, which would on whole still be a relatively strong farm income number, but again, probably a number that's indicative of two sectors still sort of moving in different directions. Now that's the projection for what's ahead, but let's recognize all the uncertainty that goes into it. And, leave it to economists to try and figure out how to measure the things that we don't know. We're often accused of knowing the price of everything and the value of nothing. We know how to measure everything. Well, economists have figured out how to measure even the things that we don't know, which is to say, economists have produced an index of uncertainty based on the uncertainty surrounding news accounts of economic and policy questions, uncertainty over economic forecast, uncertainty over the tax code. Well, you plug those economic numbers in, and we are at record levels of economic policy uncertainty. We peaked in April and May, which is, interestingly enough, exactly the time that President Trump announced Liberation Day of reciprocal tariffs on every country across the globe. So we peaked amid a great deal of policy uncertainty. We have fallen back a bit. Well, in fact, the reconciliation bill this summer did address at least the tax policy questions. So maybe we've reduced some of the uncertainty here, but we're still full of questions about where we might be going. And if you think about the ag projection particularly, Alejandro, you noted the questions that producers have about biofuels as a potential demand driver going forward and exports as a potential demand driver going forward. But both of them are fundamentally also dependent upon policy questions that we don't know yet. What is the state of potential negotiations and breakthroughs on trade that might mean that those price projections could improve over the coming months? What is the status of all the policy questions on biofuels that are sort of a driver of future demand growth there as well, both for ethanol and renewable diesel and even sustainable aviation fuel? Lots of questions that we really don't have a crystal ball on yet. And importantly, projections don't assume the things that we don't know. So those potential developments are yet to be built into these projections going forward. So that's the synopsis of where we stand and where we are as of today. That leaves us with the fundamental reality. We're dealing with lower crop prices. We know we're dealing with receipts and challenges to cash flow. Livestock receipts will seemingly stay strong as long as cattle prices stay strong. But we presume there's an expiration date on that too at some point, as the livestock herd may eventually start rebuilding. The farm income safety net has played an increasing role at the moment, principally as ad hoc assistance adds to the bottom line. But we don't expect ad hoc assistance. It might come. There may in fact be billions of dollars in trade assistance to be announced soon, but we don't know. And we can't really bank that uncertainty going forward. So the question is, how does the farm income safety net play a role? The commodity program and the changes that were passed this summer do matter, and they will substantially increase the support going forward. But insurance remains a key part of that safety net as well. And of course, management fundamentally has to be there. All of the prospects for crop and livestock receipts, the outlook for expenses, the safety net from the government only sort of sets the parameters of what producers manage with. They don't resolve all the management questions that producers have to work through. And that's where being money smart this week, but not just this week, every week, that's where being close, paying close attention to finances and understanding the potential impact of uncertainty ahead is really important for producers. So with that being said, let me stop this so that Alejandro can come back with us on camera as well. And Shannon, I'll turn it to you to start some discussion.
Okay, sounds good. So we have a question from one of the attendees. Does this include any guesses on the talked about soybean assistance?
Alejandro, I'll let you start on that.
Yeah, thanks, Brad. So not specifically about the trade deal. I think you are referring the person who wrote that question is referring to the trade deal between China and the U.S. to buy 25 million metric tons per year over the next 3 years and 12 million metric tons over the next 2 months. These projections do not include that piece of information because that trade deal was reached after we completed the process of generating these projections. However, our initial set of assumptions when we built these projections for 2025 and 2026 assumed that trade was going to be affected in 2025, but going into 2026, soybean trade would normalize. And in fact, we were already predicting an increase in soybean prices going into 2026. So in some sense, since these announced volumes are not very different from the recent history of purchases from China, I would say that our projections are in line with what is expected from this new trade deal.
And that's specific, Alejandro, you might say those are projections looking forward, maybe in line. The exact impact in 2025 could still be yet to be felt.
Completely agree. Yes. Thanks for clarifying that. Yes.
Yeah. And the same way with potential trade assistance. Even if there is recovery here in markets with a new deal with China that increases soybean sales imminently, there has still been talk of a trade assistance package for producers. These projections do not include that potential because it's not certain. So that's the reality as you look through all the government payment projections. It only estimates the programs that have been announced and that have been implemented. And it does not guess, these projections do not guess about what might be to come.
Okay. We have another question. It is, how is the government assistance allocated? Is it going to potentially be, and you both may not even know the answer or have an idea, acres planted or production?
If I can take a stab, I would say the assistance that is rolled out so far this year included the emergency crop assistance program, the economic assistance, and that fundamentally rolled out in conjunction with covered commodities that are already enrolled in the farm program. So it effectively is a formula tied to farm program participation, if I remember correctly. The ag disaster assistance portion of that rolled out first in a phase one or a stage one that were tied to producers with crop insurance that had claims that had received indemnities, because that produced the loss information that could be used to calculate the higher top up in disaster assistance. There's a second stage of that where producers who did not have losses go in to file. That's not to say they did not have a loss. They did not have a loss big enough to receive a crop insurance indemnity. So those producers go in to file a loss to determine what their potential disaster payments are. So there's an ongoing process.
Okay.
Alejandro, I believe your national numbers and thus the state numbers fundamentally are allocated based on the expected payments in Nebraska are a function of the current share of payments in Nebraska to date.
Yeah, that's
as
exactly
opposed
right. Yes.
as
Yes, we
opposed
look
to
at
expectations.
the payments in through the Emergency Livestock Relief Program, the Emergency Commodity Assistance Program, and the Supplemental Disaster Relief Program for each state. Disbursed so far until October, and use the same proportions to allocate what's expected as a total payment from ad hoc payments for 2025 minus $7 billion. So our assumption is that $7 billion out of the $35.2 billion in supplemental and ad hoc disaster assistance payments will be moved to 2026, will be paid in 2026. But the remaining amount would be allocated across states in the same proportion as those payments have been disbursed so far until October.
And I might, if I dare speculate about how a formula might work on a program that hasn't even been announced. If there is trade assistance to be announced, how might it be paid out? Well, if you go back, there were 2 rounds of market facilitation program payments in 2018 and 2019. In 2018, then Secretary Perdue had the responsibility of implementing the payments, and they calculated an expected loss due to trade conflict by commodity, and then they made a payment according to I believe commodity acres and improving yield or something to calculate a payment to producers. In 2019, they looked at losses by commodity, but then they developed an average loss per planted acre in the county, and then that effectively produced a county-wide payment rate tied to planted acres on the individual operation. So in one year, they used a very specific calculation by commodity. In the other year, they calculated losses by commodity, but then made an average payment across the county. All that to say is that's speculation about a formula for a program that hasn't even been announced. But if it were to come out, you could expect that there's some math behind the calculation.
Okay. Sounds good. I'm not seeing any other questions at this moment. Do either of you have anything else you want to add or talk about real quick?
If I may, I just want to reinforce the idea that whatever cash farmers and ranchers can get a hold of, it's a good idea to use that as a cushion for the possibility of not seeing ad hoc payments fast enough in the coming months. So yeah, trying to protect the cash flow of every operation, I think, is crucial at this point in time.
Yeah. Yeah. I think that makes a lot of sense.
Yeah, and I was shaking my head no, because at that exact moment, the construction right outside my room was going full blast, and you can
Okay.
so in between noise here, I think I'll
Goodness.
say I don't have anything additional to add. we
Okay.
continue to have to watch it closely.
Yes.
And we know producers are challenged with the financial conditions, particularly on the crop side, and lots of work to do, but we'll pay attention and continue our work on it.
Okay. Well, thank you everybody for joining us today during Ag Smart Money Week. Webinars will continue through tomorrow, Friday, and you can see the full schedule and registration information at cap.unl.edu/smartmoney. Thank you, Alejandro and Brad, for joining us today, and have a great afternoon.
Thank you very much.
Thank you. Take care all.